am now recording. So, share. Okay. So here's my very nice blank journal. Okay, so it doesn't look terribly confusing here. On the far left-hand side, we have the date. Again, we should be arranging journal transactions in chronological order. Means business transactions that happen first are recorded first. Okay. The next column is where we post or mention the specific accounts that are being affected by the journal transaction, and it's also space for a general description about the transaction itself. The next column is our journal reference number. Here we can include things like purchase order numbers if it's an invoice, sales order numbers if it's a sales slip. If you have no information on any of those things, like an invoice number, sales slip, you can label them 1, 2, 3, 4, 5, 6. As long as there's some sort of reference number for you to identify which journal transaction is which. It helps a lot, helps later down the line when we start to post ledger. Okay, you're going to find that it's very easy to make a mistake while doing this. Okay, these reference numbers help you quick check yourself, opposed to doing it all over again. The next column is where you would put any debited money or debited information. And on the right-hand side, that's the column where we would put any credited information. So again, this is just a big list of all the journal transactions that have happened over the course of a week, a month, a quarter, things like that. So let's start with our first one here, right? We've paid $3,500 for a new oven. Let's say we did this on January 1st. So January 1st, there we go. We got the date. The first account you list in the transaction, or sorry, in the journal, is the account that's being debited. Okay, so we've paid $3,500 for a new oven. What two accounts are being affected? Cash and equipment. Which one is being debited? Both are assets. Equipment, absolutely. So we put equipment. We list equipment first because that is the account that's being debited. Let's say our journal reference, because we have no particular reference number here, let's say it's journal reference number 1. So how much are we debiting our equipment by? $3,500, exactly. Perfect. Now the next line is where we mention the account that's being credited. Again, debits must equal credits. We've already debited something, so now we need to credit something. So in this case, the next line, which is the account being credited, it is indented. Indented. It's going to look funky, but it's indented. What account are we crediting? Cash, absolutely. Cash, and it is credited by $3,500. So at this point, we've read the the business transaction. We understand which two accounts they're affecting. In this case, it's equipment and cash, both of which are assets. So we know how to organize the information that's at play here. For example, equipment, the value of our equipment is going up because we now have more equipment. So we debit our equipment by $3,500 to show that the amount of our equipment is increasing. Next, we show our cash, which is decreasing, so we show that it is being credited because assets decrease on the credit side. The last step in this particular transaction or posting is to give a brief definition as to what happened in this transaction. So based on the description here, what would you say this transaction is about? Bought a new oven. Now, as simple as that is, we need a little bit more. Okay? Typically, we communicate our transactions with the beginning two words, to record. So in this case, absolutely we bought a new oven, but the description of this journal entry is to record the purchase of equipment for cash, with cash. So let's just doctor it up a bit here. To record the purchase of equipment, I spelled equipment wrong, equipment with cash. First journal entry done. We show the accounts that are being affected, and how they're being affected, and by how much. And we use the rules, the debit and credit rules, to do that. Our next example here, let's say this happened January 2nd. We've purchased $1,000 worth of food products, okay, with cash, let's say. What two accounts are being affected? Inventory and cash. Specifically, what's happening to our inventory? It's increasing. What's happening to our cash? Absolutely, it's decreasing. We have to show the increase to the inventory. We also have to show the decrease to our cash. Because these are both asset accounts, we know how to increase and decrease them. Increase to asset accounts are posted on the debit side. Decreases to assets happen on the credit side. So, using that, what account do we list first? What account are we debiting first? Inventories, absolutely. Let's be specific. Food inventory. There we go. Let's say this is our second journal number. And by how much are we debiting? $1,000. There we go. Now, the second account that this transaction is affecting is what? Cash. Cash. And what is happening to our cash? We're crediting it to show that the amount of cash that we've used cash, and our balance, our cash is going down by $1,000. Now we have to give a definition for this particular transaction. Again, we want to start this description with the two words to record, because that's what we're doing. We're recording. To record what? What would we be recording here? Exactly. To record the purchase of food inventories. Check. Done. We've recorded the two accounts that are being affected, how they're being affected, and by how much. And then we give a general description. Okay? It's important to note that the actual the layout of this is actually quite important. To be prepared in good form, a journal entry, but the first account must be the account that is being debited. The second account must be indented and be the account that is being credited. It must have a reference number. If there is no reference number, make one up. It must be in chronological order by date, and it must always have a description. That is generic yet specific at the same time. That's an oxymoron, I get it. Simple yet slightly specific. For instance here, to record the purchase of food inventories. It's very general. That's quite short and simple to the point, but it's also very specific. food inventories, purchase of food inventories. Our next example here, we purchase $450 worth of beverage products to be sold. So beverage inventory. What two accounts are being affected here? Beverage inventory and cash again. Which account being debited?
Beverage.
And which account is being credited? Cash, right? Our beverage inventory is going up and our cash is going down. So our first account, and we're going to say this was January 3rd, is our beverage inventory. Say this is our third reference or our third transaction. It's being debited by $450. We're debiting it because our food inventory is increasing and assets increase on the debit side. And we're crediting our cash because our cash is decreasing. So here, our debits equal our credits. Debits equal 400, debits equal 450, credits equal 450. We are in balance. We give here a quick quick description. What description would you give? Yes, to record the purchase of beverage inventories. To record the purchase of beverage inventory. Inventories. There we go. We're not going to do this one just yet. Actually, we will do this one, but after this one. Your food sales for the day were $850. Okay? Yes. Oh, I thought that was a hand raise, even though it was a finger raise. What two accounts are being affected here? We are recognizing. Okay, so maybe before we try and think of what accounts are being affected, describe this journal transaction? How would you do it? To record food sales for the day. So there, in the description, we know one of the accounts, food sales. We are affecting food sales. If we're getting sales, let's assume here this is $850 cash. Okay, so it's affecting cash. Your sales go up, your cash also goes up. Your accounts receivable can go up, but it's not detailed in this particular example. So we'll say cash. Okay? So your revenue is increasing and your cash is increasing. Is that clear? Does that make sense? Revenue increases, so must cash.
Inventory decrease as well?
Yes, but that's a secondary transaction. That's where we get here. So we're going to hold that thought. Okay, so let's say this is January 4th. Okay, so we're recording the sales for January 4th. What is being debited in this case? Our revenue is going up, our food sales going up, and so is cash. Which one's being debited? Refer back to that rule sheets of debits and credits. We have an asset account increasing and a revenue account increasing. Which one increases on the debit side? Assets, absolutely. The revenues increase on the credit side. So our cash is increasing. Let's say this is our fourth transaction. Cash is increasing by the amount of the revenue, which is in this case $850. So we debit cash by $850. Next, we have to credit something because our debits must equal our credits. Which account? Sorry? Which kind of revenue? Food sales or food revenue. So in this case, we'll call it food sales. Whoop. And we're crediting it because revenue or sales increase on the credit side. So we are crediting it by $850. And our description here would be to record daily sales, to record daily food sales. So in this particular transaction, we have the date, it's chronological. We have a description. It is brief but detailed enough for us to know what's going down. We have the two counts being affected. The amounts equal, so our debits to credits equal. And we have a reference number. Can I have, does anybody have any questions, or can I help answer any questions about that one? No? So now we're going to go to this example here. So you conduct a food inventory, and you find that your cost of food sold was $570. Okay? Cost of food sold is technically an expense account. That's why I didn't want to go into this right away. So maybe we'll just give an explanation there. Cost of food sold is an expense account. However, it is also a contra asset to show that it's decreasing. If your cost of food sold was $200, you know that you sold $200 worth of food, and you must recognize the expense, but also you now have $200 less inventory, right? That's how we show the effects of this particular transaction. We have to show that our cost of food sold has increased to show that expense. We must also decrease our inventory by our cost of food sold to reflect the current level of our inventory. So do expenses, because cost of food sold is an expense, which side do expenses increase on, debit or credit? Debit. Expenses increase on the debit side. So if our cost of food sold is an expense, we know that this is the first account we're going to list. So we're recognizing the expense. We must also reflect the current level of our inventory. So cost of food sold is, let's say, $100. We must also reduce our food inventory by $100. Our inventory is an asset account. Do asset accounts increase or decrease on the credit side? They decrease. And that provides the basis for this transaction. So let's say this is January 5th. There we go. The account that we're debiting is our cost of food sold, which is an expense account. So cost of food sold. There we go. This will be our fifth transaction. Our cost of food sold was $570. There we are. Now, we must also reflect that our inventory is decreasing, right? We sold $570 worth of food inventory. We must now decrease our food inventory by the same amount, $570. And then the description here would be to record cost of food sold for the week. You can see and appreciate now how the general journal is essentially just a list of transactions. Very much like this is here. We've gone and listed them in the general journal. Specifically, we've listed the accounts that are being affected by each transaction, by how much. Yeah, that's pretty much what we're doing. Which accounts were affected and by how much, yes.
And it's also important that you're stating like the amount of time in the note, right? You know, the note underneath the line.
For cost of food, yes. It makes a difference between, it makes a big difference, yeah, because then it helps put a context to a number. Yes?
So the cost of sold would be going to expense.
Cost of food sold is an expense, yes. Okay. Are there any other questions? Okay. Okay, so I'm going to stop sharing this now and conclude that recording. And we'll do another exercise.